Hi, I'm Steve Van Meter, and today I'm joined by Alfonso Peccatiello. Alfonso, thanks for joining me.
Hey, thanks for hosting me, Stephen. It's a pleasure to be on Real Vision again.
Alfonso, for those who don't know who you are, can you tell us a little bit about who you are and what you do?
Sure. I am the author of the Macro Compass. It's a free macro newsletter where I write about market developments and global macro. And you can find it on Substack, but we can talk about that later on.
Perfect. Now, when I first heard you on Real Vision, I went to your blog and I started following on Twitter, and I immediately said, I got to sit down and talk to this guy because I think there's a lot of things that we agree on, and I think there's some things we disagree on, and there's some really hot macro topics that I'd like to get into. And the first one I want to start with is this whole inflation deflation story. Now, I think many people know I'm on the deflation side of this camp, and I'm in a minority. But where are you on this, and what's your reason for that?
So before I start answering questions, just a small disclaimer. I forgot to put it before, and I still need to put it out. So I also do something else on top of writing this newsletter, which is what I do as a job. But I do not represent my employer in this interview. Everything you will be hearing is just on behalf of me, myself, as a private person. Now, we can go ahead with the more interesting part, I think, not the boring disclaimers. So I am on the disinflationary camp. So, inflation or deflation, I guess there is some sort of a gray area. It's tilted towards deflation, but I will call it disinflation, Stephen. So I think global economies are still will still be able to produce some positive year-on-year inflation numbers, but it's just that the pace of these inflation numbers is rather going to be very shallow. Let me put it like that.
So what are some of the signals that you look at to determine whether this is transitory or not?
Yeah, so I think you just have to try to get the big picture here, right? So let's look at the forest rather than at the trees. So our monetary system is basically built on trying to overlay credit expansion to generate cyclical growth on top of what we have as structural growth, right? And the structural growth is just the labor supply. So the people that are productive for the economy, and how productive are they? And how productive is this capital that is through the economy, right? And at the moment, if you look at the structural factors, they're pretty poor. Demographics is what it is, and productivity is pretty stable, and it's not going up. And capital misallocation is all over the place, also because of monetary policy. So, the structural forces are pretty shallow. So what we try to do is always to overlay cyclical growth on top. So it looks like that we're growing in a healthy fashion, right? But what we're doing is just we are using credit effectively to overlay on this. So every time we have this credit impulse growing, people feel like it's a regime change. It's the nice side of the medal. It's 2018 all over again, or it's, I can make other examples, but it's 2018. It's late 2020, beginning 2021. It's all these regime changes that you hear a lot. And at the end of the day, they're just credit sugar rushes, as I call them. You push credit through the real economy. It generates earnings, GDP growth with a lag. It moves into financial asset pricing with a lag. So all the high beta, the industrial commodities, bond yields even go up. Inflation expectation temporarily go up. But once the credit sugar rush is over, you deflate the balloon again, and you end up back to have to handle your structural forces behind your economic growth, which are pretty poor.
Yeah, I really agree with that. The credit is a huge piece of this puzzle, and I don't think a lot of people understand that. I think a lot of people right now are focused on the stimulus. What are your thoughts are with not only the credit bubbles, coming back down, but a lot of the stimulus, particularly in the United States, where we're seeing a lot of inflation on September 6th, we're going to see the last of the extended with not only the credit bubbles, coming back down, but a lot of the stimulus, particularly in the United States, where we're seeing a lot of inflation on September 6th, we're going to see the last of the extended unemployment benefits go away. And we're also seeing some of the rent moratoriums and the student loan moratorium payments in. Is that going to accelerate the downside move, or is that a non-issue in your book?
This feeds into the credit impulse data. So if you look at chart 1, I prepared a small chart back for this interview. It represents the global credit impulse. It's the G5, so the 5 biggest, largest economies' credit impulses. It's the blue line as percentage of GDP, and it's then matched against US inflation expectation with a 12-month lag. And what you're saying, Stephen, is basically the massive fiscal stimulus we saw in 2020 and early 2021 is reflected in this global credit impulse chart. So the blue line when the government spends on a net deficit basis and the private sector does not offset it because the government is not asking for taxes in order to fund this spending. It's literally deficit spending. And when commercial banks increase their loan books, which is also what it happened in 2020 thanks to government guaranteed lending, bank lending, when those two components actually start, then this global credit impulse goes up as a percentage of GDP. And the credit impulse actually measures the acceleration or deceleration in this credit creation process. So in 2020, you see that there was a massive acceleration. You see how the blue line went up very quick. But the blue line also peaked in Q4 2020, which, coming back to your question, is exactly the moment when effectively all the largest fiscal stimulus packages from the US were produced already. So there was no new huge gargantuan fiscal stimulus coming up. So the acceleration in credit creation peaked. And if you give it a little bit of lag, 6 to 9 months for earnings and GDP, and about 10 to 12 months for inflation expectation and asset classes, those will also peak, obviously. So we are now in the phase where all the high beta part of the economy has probably peaked already. And we are now facing the usual credit cliff that mind you, we faced as well in 2019. Do you remember at the end of 18 where the Trump fiscal policies were taking full-fledged into the economy? We were at negative output gap when Trump announced about $1 trillion-ish fiscal stimulus back then, which is now seems very little, but back then with the zero output gap was actually pretty large, right? And then what happened? Of course, credit expansion. And then in 2018, with a little bit of a lag, we felt like this was a regime change and the Federal Reserve could hike to 5%. And we had, I think, Diamond calling for treasuries at above 4% and all that stuff, right? It's the typical hype. It's the reflation hype, as I call it. And then the credit sugar rush is over, the cliff comes, because it always comes unless you're able to produce more and more and more credit. Remember, it has to accelerate even. It's not enough to keep the pace constant. The acceleration has to go up. You're just not able to do that. And therefore, you face just a normal fiscal cliff, a credit cliff. And when it comes, guess what happens? Jay Powell has to tell you we are not on autopilot anymore. It has actually to pivot and to even cut rates in 2019. The ECB has to restart quantitative easing and so on and so forth.
I find that very fascinating because a lot of people don't talk about credit impulse. I don't think they understand it. And if I'm reading your chart right, the downturn we're seeing in Treasury yields here is actually an indication that we're at the beginning phase. And looking at your chart, if I'm right, we're not going to see this bottom out until middle of next year.
Yeah, I mean, this chart has to be interpreted. The correlation looks very nice. I do agree, but this chart has to be, it's called the credit impulse and not the crystal ball for a reason, right? I mean, you interpret this chart for direction of travel and not necessarily for the exact magnitude or the exact timing of the move, right? So I don't want anybody to pinpoint this and say, credit impulse peaked in Q4 2020. After exactly 9 to 12 months, we'll have to see exactly this drop. That's not how the chart works. It is an indication for the direction of travel. So this chart also predicted bond yields to actually peak in about May this year. They peaked a bit earlier and then they remained in 10-year treasuries about 1% until May. And then May, which is exactly 9 to 12 months after the peak in credit impulse in 2020, also seems to be the peak for 10-year yields here. And we have seen a little bit of retracement, and this chart would anticipate that inflation expectation will have to adjust lower. And once they adjust lower, if nominal yields also do not adjust lower, accordingly, you will have higher real interest rates for the wrong reasons. So you will have inflation expectation dropping and nominal yields not dropping, which is normally a very toxic cocktail for risk assets. And I don't think the Federal Reserve has any interest in achieving that. So I would have to expect that the peak in 10-year treasuries yield is definitely behind us, yes.
Yeah, and looking at the chart and what's going on, particularly with quantitative easing, which I want to get your opinion on, it appears that from my side of the story that yields are on the cusp of a major move lower. And maybe today's FOMC meeting is just the last pause in that move. But you're right. I don't think the market is expecting this and the Fed isn't expecting it. But it appears that it's going to happen very soon.
It might actually. So I think the nice move we saw from 175% to 120% is already pretty significant. If you think about it in volatility terms, with this very low implied and realized volatility in 10-year treasuries, if it moves down to 50 basis points, is already relatively significant, I would say, in a zero lower bound world. Will we see more? let's say I wouldn't be bearish on fixed income here at all. And I think the direction of travel as indicated by the chart is relatively clear to me, at least for what concerns inflation expectation. But as we discussed, if inflation expectation drop, it's very difficult for nominal yields not to follow, because it would mean higher real yields and it would mean a pretty toxic environment for risk assets. You touched on QE, which seems to be the thing I'm the most upset about QE is that we have done this from Japan to today for about 20 plus years, and we still have to talk about it. And there are so many misconceptions out there. And, I don't think those are even debatable things. I mean, I tried to explain in an interview with Jack Farley a few weeks ago how the mechanics of QE works. And I prepared a chart maybe to try and go over those again. But the bottom line I want to pass through is QE is an asset swap. And I hope you have heard it before me. You should have, people listening to Real Vision. What's happening here, if you look at the chart, this is from Bank of England, by the way. So it's from an entity that is a monetary policy authority and is trying to explain you how the monetary policy instrument called quantitative easing works. And they're putting a pension fund into the equation. It can be any other seller of government bond on their balance sheet to the central bank. It really won't change the equation that much. So if you look at before asset purchase on the left and after asset purchase on the right, you will see that let's start from the central bank, maybe, which is supposed to be this omnipotent authority out there able to influence everything that's going on in the real economy and in markets. Now, what they're really doing here is from before asset purchase to after asset purchase, so focus on the center part of the chart and move from the left to the right. What they are doing is they are increasing their liability side by creating bank reserves out of thin air. Yes, they can do that. They can create bank reserves out of thin air, and they will use these bank reserves to buy government debt, which is the purple stack on the asset side of the central bank that got summed up to the previous balance sheet, right? And they will buy this government debt in this example from the pension fund. So if you move eye up on the chart, you will see the pension fund that had government debt before and gets an asset swap. So government bond is out of the equation for the pension fund, and they instead get something else. Now you move on the right side of the chart after asset purchase for a pension fund, and they get a bank deposit. And why is that? It's because when a pension fund sells a bond to, let's say, an intermediary, but to make it easy, sells a bond to a central bank, which is not exactly how it happens, but again, for sake of simplicity, they get some form of money instead. This form of money for a pension fund has to be by default deposited overnight at a commercial bank. That's the default. They don't have a choice. They don't have an account at the central bank. They have to put this into the commercial banking sector. And now you move on the bottom of the chart. So what happens to a commercial bank balance sheet is that they will receive the deposit from the pension fund, and this will be matched on the asset side of the commercial bank by this higher green stack, which is a bank reserve. Now, what the hell can a bank do with this bank reserve? I have to breathe before answering this question. No, bank reserves cannot be lent out. They are already on the asset side of the balance sheet, and it's an item of their balance sheet that they can use to settle interbank paying systems or settle transaction with their local central bank. Can this be turned into inflationary forms of money? 99%, no. There is one way, which is if everybody today would go to a commercial bank and we would withdraw all the cash, then these reserves will have to be basically backing the cash we withdraw from the ATM. This is not how an economy works. 97% of our transactions are digital. These bank reserves are an item that can be used to settle interbank transactions. Oh, but now the commercial bank has more deposits, so it means they can lend out deposits. No, commercial banks do not lend out deposits. Every time a loan is made, a new deposit is created. So it's not we use existing deposits to lend. We make a loan, new credit is created, and per accounting identity, this is not even debatable, per accounting identity, as my balance sheet increased on the asset side, it has to increase on the liability side too, and that increase will be the deposit that has been created together with the new lending. So what did QE do in all of this? Because that's where we started. It simply swapped the asset side of a pension fund or a bank or any other financial intermediary from having a duration-intensive asset, a government bond, into a zero-duration asset, which is a bank deposit or a bank reserve. And that's it.
And yet, everybody thinks it's money printing.
Yes, pretty much.
And, I've talked to a lot of people still today, even financial professionals, and I know you're going to struggle to believe this is true, but even financial professionals today are telling their clients it's money printing. And I asked them, first of all, are you watching, some of this content out there? Because we really, you're explaining it, I'm explaining it. And I asked them, what is the reason behind that? And this blows me away is they say, well, where did all this government stimulus come from? I said, it's borrowed. And they said, are you kidding? No, people think that we just printed money out of thin air and gave it to them. They don't realize the governments are actually borrowing money. And I don't know, what is your reaction to that?
When I explain this, what happens normally is that people tend to tell me, yes, but the central bank is monetizing debt, right? So that must be money printing. Now, here I was explaining how quantitative easing works. If you put government net deficit into the equation, then we can discuss about how government net deficit works. And then we can discuss about what the other form of credit creation is, which is commercial bank expanding their loan books. Okay, those are two separate topics. So a quantitative easing process from the Monetary Policy Authority might accommodate deficit spending. Yes, it might. But in that case, if you're looking for inflationary form of credit creation, so the government sending you checks at home that you can literally spend, all right, you should look at that. You should not point at QE as the form of money printing. You should rather look at commercial banks creating new money when they land, or the government sending you checks at home without asking any taxes back. Okay, so, and if, by the way, let's talk about government spending. Because government spending related to money creation is only half of the coin. When the government decides to spend money that it doesn't intend to tax you for to get them back in the future or now, so they're doing deficit spending, you as the private sector might decide that you don't want it, you don't need it. This money reaches your bank account and you're like, whoa, what am I going to do with this? Okay, let's look at my opportunities out there. So I am an over-leveraged private sector. Private sector debt to GDP in America is 165%. It's almost as high as it has ever been. And remember, the private sector cannot print currency to get away with their debt. They need cash flows to service their debt. All right. So they are not that happy to be over-leveraged unless they think their salary is going to go up, earnings are going to go up. Unless they think that, they're not that happy to be that leveraged. So when they receive a check from the government, they might want to think, maybe I'm going to use some of that to pay back my debt. And this is what they did for 50% of the checks that were sent to Americans were used by the private sector to deleverage. What this means is the private sector is offsetting half of the credit creation by the government because they're destroying existing credit out there. So they had a debt. The flip side of the debt is credit. They choose literally to take the newly created credit to pay back their debt. So when you look at net spending, you're getting half of the equation. You should look at the private sector too. So what is the private sector trying to tell you? In Japan, for the last 20 years, the private sector has managed to almost unwind completely every government spending that has been out there. They just want to deleverage. They are not happy being very leveraged because they know they need cash flow to service this leverage. And they are seeing where the economy is going.
Yeah, I think you made some really key points there, and your explanation of how this works is flawless. I know you realize that it's absolutely flawless. And when you have stimulus that goes to pay off debt, it destroys money. And when you have stimulus that goes into savings, it doesn't do anything. So you have to really look at what's spent from a discretionary standpoint and a very small portion of that. And then you have to look at what amount of that went to create new loans, perhaps as a down payment, where you're really getting money creation. And when we look at the credit data, we see there's nothing. There's no growth going on. And that really comes all the way back to your credit impulse chart that we talked about in the beginning, saying, look, this looks like it really worked. We all, drank the soda, got high in caffeine and ran in circles for a while.
Yes.
And now we're about to come crashing down.
Yes, that's normally the cycle, right? And then the other thing that I get back is, yes, but the government is now going to go with another round of stimulus. And okay, so that's plausible. It is possible, of course. It is possible that we move to fully fledged, let's call it MMT, although that's not exactly the right definition of what we did, but MMT-esque policies, right? We move towards that. Now, I have 2 points to that. We normally measure inflation and asset performance year on year. So the benchmark for 2022 inflation is going to be the CPI basket of June 2021. That's what June 2022 year-on-year inflation is going to be measured against. Now, without meaningful large credit impulse in 2021, after June 2021, right? So you give it a little bit of time to feed into the real economy. Would you please explain to me, how do you expect aggregate demand to be there in size big enough to push this inflation basket price meaningfully higher, because people are talking to me and expecting this 5% inflation to remain there for years and to be sticky. So where is this aggregate demand push going to come year on year when we measure prices next year? From where? I don't have the explanation so far for that theory, because you either expect massive supply bottlenecks to remain there forever. So you basically expect companies never to be able to produce commodities and chips and anything that is causing shortages now. Never. They will never be online again. They will never produce again. It will be the same level of supply bottlenecks we saw during the pandemic, also next year, for some reason. Or you expect aggregate demand to be year on year as strong as it was when the government went with the largest ever fiscal program we have ever seen. Now, I haven't seen any super large fiscal program of late. The last one I've seen is dated beginning of 2021. And after that, I haven't seen much. They're still discussing this infrastructure plan. Let's call it infrastructure, whatever that is. But midterm elections are coming. There is always an electoral cycle. And when there is an electoral cycle, there are incentive schemes to make sure that money are spent or not spent, such that any party can claim they're doing some work behind. So there are negotiations. You cannot expect a crisis program when there is no crisis. That's not how it works.
Right. And I think with infrastructure, they're spread over 8 to 10 years. So a big number divided by 8 to 10 isn't a big number. And I think one of the key points when you're talking about, can prices stay sticky and stay up? I look at it from, can the consumer afford it? And without all this stimulus and still a large number of Americans on unemployment and set to lose those benefits and have new bills. Well, I shouldn't say new bills. They might be new because they haven't paid them on a while coming back. I keep asking the question is, how are people going to afford these higher prices? And if they can't, they get rejected and you get lower prices. Do you agree with that?
Yes. So this magic economics based on the government being able to take on all the aggregate demand that is needed, all of it. So we basically have a government controlled aggregate demand that is going to be higher and higher year after year, because the government is going to push more and more and more and more deficits down the road, such that is able to basically take over all the aggregate demand from the private sector. I think it's a scenario. You can never discard it, but people are assigning 100% probability to this scenario when I talk to them. And I'm like, okay, guys, this seems to be a tail scenario to which you should assign a probability, but definitely not 100% to this probability. So the aggregate demand push from a sector generally comes from real wages, inflation-adjusted wages. Now, if real wages are going up on a sustained basis, you can expect people to have more healthy aggregate demand and more healthy, attitude towards consuming and spending. Now, inflation-adjusted wages, real wages go up when the economy is productive, when the labor force is there, and when the labor market is very tight, like literally very tight. We need participation rates to go up. We need the U6 unemployment rate, so the broad measures of unemployment rate that also include marginally attached labor force, discouraged workers, all these guys, we need them to re-enter the labor force. We need them to be in there to compete for jobs. That's what we need, actually. That's how real wages go up, normally speaking. And I'm not seeing any of this happening. And I wonder whether the pandemic had some permanent scars on the US labor market. But for sure, it is a very far-fetched statement at this stage to expect such a healthy push in aggregate demand, and it's even a far-fetched statement, I guess, to assign 100% probability to the government taking over all the aggregate demand that is needed to constantly push year-on-year inflation higher and higher and higher. I think that's a very low probability scenario.
Yeah, I agree, because there is a lot of sentiment that the government is going to continue to dole out money. And you mentioned one very important point, is we're in a 2-year political cycle, not a 4-year, and midterms are coming up. And, right now there isn't, we can't even get an infrastructure bill going. So it doesn't appear to be a lot of demand, yet consumers are just expecting, there'll be more checks if I don't go back to work. Well, I think we'll see. The jury's still out on that one. But I want to shift gears here because there's a really hot topic I want to dig into, which is this whole reverse repo thing.
Oh, cool.
So here's what I want to know. Now, we saw repo become a long stretch of a precursor to the great financial crisis. So a couple questions for you. Is reverse repo a precursor to a crisis, or is it just a non-issue? It's just a collateral shortage. What's your thoughts on it?
So reverse repo, let's define it for a second. It's basically a commercial bank, to make things simple again. It's a commercial bank that has a zero duration form of collateral, cash, let's say, and sends it back overnight in notional terms, in collateral terms, back to the central bank, and gets something back for it, which is the collateral, which is the treasuries. So they take this zero duration form of cash, let's call it cash for simplicity. They send it back to the Federal Reserve. They get back the treasury as collateral. That's the whole thing we're talking about here. Okay, now, why would that be extremely relevant? Well, there are a couple of signals that this reverse repo might want to send out there. One of it is that we are drowning in excess reserves while we have less collateral available than compared in relative terms compared to the excess reserves out there. So there is this imbalance, let's say. There are a lot of excess reserves which are created in the process of QE, as we have seen before, and also in the process of drawdown of the TGA account. So we have these two forces on one side, and on the other side, we have less issuance of collateral. So because the Treasury is drawing down the TGA account of late rather than issuing, and because quantitative easing is absorbing these treasuries out of the private sector, we have less collateral available and we have more excess reserves. So we have this imbalance, right? So these excess reserves have to try to find a form of, let's say, remaining within the interbank system. They cannot get out, and they try to find the most optimal way. Basically, there is a sort of a release valve, a release pressure valve here. And in this case, this release valve is the reverse repo facility. So what commercial banks are doing, they're saying, okay, well, I have too many of these reserves, and please get them back and send me overnight some collateral, some treasuries. All right. So are we undoing QE?
Yes, that's the question, right? Is this that's what everyone thinks right now? Yeah. Is this a stealth form of undoing QE?
No,
I don't think it is.
No,
but what do you think?
No, so this undoes, if this is an English word, one portion of quantitative easing. So it overnight rebalances the imbalance between collateral and excess reserves overnight. And as long as banks do it overnight, you might want to argue it has been rebalanced partially for a month or 2 or 3 months or whatever. So the collateral scarcity, if you want to call it, or the imbalance, as I call it, between excess reserves and collateral gets rebalanced via this mechanism, reverse repo, overnight rolling. Please notice, it's important, overnight and rolling. It means tomorrow banks might decide to basically deploy these excess reserves in some other forms. Okay, so it's not a guarantee. While quantitative easing on the other side has many more aspects together with this collateral exchange. The most important one, I would say, are two. The first is there is a different time horizon. As we said, the reverse repo is an overnight facility. So banks might decide to do it today and not do it tomorrow. QE is not an overnight facility. QE is I would argue, almost permanent drain of collateral away from the private sector. And it's at least a multi-year facility. So the drain of collateral away from the private sector in the form of bonds being bought and put on the central bank balance sheet in exchange of excess reserves, this is a semi-permanent, or anyway a relatively long time switch of collateral. All right. The reverse repo is an overnight imbalance fix that can be stopped tomorrow if commercial banks find a better way to reduce this imbalance. That's the first very important difference. The second one is QE also took away duration risk from private markets. So when the government wants to borrow to finance their spending, they need the private sector to actually buy these treasuries, right? And when the private sector does, it takes some risks. It takes duration risk, it takes credit risk on the treasury, assuming there is any credit risk on the treasury. But okay, it takes mostly duration risk. When the central bank comes in and takes away this collateral from the market, it also almost semi-permanently reduces the duration risk that the private sector has to absorb, because they simply do it on behalf of the private sector. Reverse repo does not give back duration risk to a commercial bank. It only exchanges back the notional and the collateral. And that's it. So we are not undoing QE. We are just overnight trying to rebalance the imbalance between collateral and excess reserves. And that's it. So it's getting a lot of headlines, but I would say it's an overdone statement to assume reverse repo is such an important topic.
Right. And I think there's some key points you made. First is quantitative easing is semi-permanent. It's at the direction of the Fed, and only the Fed can undo it. A commercial bank can't go to the Fed and say, hey, I'd like those Treasury securities back, because I think we could easily argue they'd like them back right now. The Fed's got a lot of collateral that the banks could want. And when you look at reverse repo, it's designed to stabilize money markets. And what you have is too much cash. And all the Fed's doing is saying, if you have cash that you don't want, we'd like to borrow it for the night, and we'll pay you interest. So the Fed's not forcing anybody to do anything. But because there's all this cash in the banks and money markets, they don't have the collateral to back it, and they're more than happy to go to the Fed and get the interest. Is that correct?
Great summary. I would also argue that, therefore, the reverse repo usage is sending a signal, and the signal is that there is an imbalance, a large imbalance. So can the Fed act on it? Yes, in principle they can. Can they use this signal to slow down quantitative easing because maybe the imbalance is getting too big? Yes, they can. Do they have other ways to fix this? Yes, they have. But assuming this is literally QE undoing without the consent of the Fed, or a stealth QE undoing, which is willingly sought after by the Fed, well, that's just a fantasy. It's a signal of a collateral imbalance against excess reserves. That's what it is. Will the Fed interpret it one way or another? We'll probably see tonight, but it's in any case nothing that relevant.
Yeah, and there's something I want to get your opinion on that. So the way I look at this is, we go back to the Basel III banking regulations post Great Financial Crisis, and due to all the stimulus money, bank balance sheets ballooned, and they didn't want that. That of course, the whole point, and I realize you know this, of the Basel III banking regulations is to shrink the bank balance sheets. So all of a sudden, they're literally getting force-fed all of this money, and what's their choice? Or stop lending. And so I look at reverse repo as a relief valve for the banks to shrink their balance sheet, because behind the scenes, there's something else that happened. The banks stopped buying treasuries. And I think the Fed really wants them to buy more treasuries. And as soon as we saw this really big numbers in reverse repo, we can now go back to the H.8. And what do we start to see? The banks are starting to buy more treasury securities. What do you think about that?
We have seen the Federal Reserve trying to make sure that the supplementary leverage ratio doesn't become penalizing for commercial banks. So there are some regulatory tweaks or exemptions that they could put in place, while basically excluding some items from the supplementary leverage ratio calculation, so that the bank's expansion in balance sheet doesn't become penalizing, right? But this exemption has basically not been extended. So as a commercial bank now, because of all this regulation, if your balance sheet is too big and it's expanded in a non-optimal way, so effectively you don't have a good return on equity in expanding this balance sheet further, it is not optimal for you to do so. And the commercial bank not expanding its balance sheet, especially when it's about lending, Stephen, it's basically counterintuitive to how our monetary system is designed. Our monetary system is designed such that credit has to flow towards the real economy. And if a commercial bank has return on equity constraints or regulatory constraints to expand their balance sheet, that's counterproductive towards how our monetary system will work. Actually, if you look at loan yields today, if you're a commercial bank and you want to lend money, right? You want to expand your balance sheet and you want to make it in a productive way. And you look at loan yields and they're very poor, they're very low. And you look at how leveraged the borrower is on the other side and you're like, whoa, these fundamentals are very poor. This guy is paying me that little for the loan that I'm going to give him. So my return on equity is very poor by definition, right? So I have capital to attach, which hasn't got any easier, as you explained before, to this loan. And then you have a loan yield, which is now very poor because of where risk-free rates are and where credit spreads are. Then you're like, why would I actually take this on my balance sheet? Why would I do that, right? And then by banks not expanding their loan books, you actually get the opposite effect. You get shrinking loan books or flat loan books. You don't get credit to the real economy, and it's a vicious circle.
Yes, and so let's apply this to what it means for yields, because I think we agree that quantitative easing is designed to suppress and lower yields. I think all this cash in the reverse repo puts downward pressure on yields. We're not seeing lending growth because the banks are, as you just said, why take the risk? It doesn't make a lot of sense. So what's your thoughts? Are yields headed broadly lower, stay the same? Or are you with everyone else that they can only go up and they must go up substantially?
No, definitely not the latter. But the reason why definitely not the latter is also pretty arithmetical. So global debt to GDP is 365% as we speak, 365% of GDP. And the public debt can always be refinanced mechanically cheaper than it should be by this mechanism we described before. So if you have the quantitative easing that creates new bank reserves, takes duration risk out of the private sector, it accommodates the deficit spending, effectively that's a relatively doable situation in any case. What worries me is private debt to GDP, Stephen. I mean, that one you cannot get out that easily. So you need cash flow to service. And if you have a huge debt burden, and you increase interest rates, risk-free interest rates, and you assume the same credit spreads, it remains constant, then the nominal yield at which the private sector has to refinance their huge burden of debt all of a sudden became higher by 1% or 2% or whatever people think Treasury yields should be now, 3%, 5%, whatever people think they should be. Do they realize that this will move one-on-one on their back, assuming stable credit spreads? I'm not even talking about credit spreads ballooning, just assuming stable, all-time low credit spreads. This would mean the private sector has to refinance a huge debt burden at 2% higher yields. All right. So now, unless you get inflation that has also gone up by 2%, this means that in real terms, you're paying 2% real coupons more on 165% US private debt to GDP. That's just, it's going to drain most of your resources towards trying to service your debt. And the first reaction you're going to have is either I think that my real earning capacity and cash flow capacity has gone up enough to offset these higher servicing costs, or I'm going to start to deleverage as fast as I can, as soon as I can. And deleveraging from the private sector means destroying credit. And destroying credit means that we slow down and we end up in a Japanese balance sheet recession, to quote Richard Koo. Basically. So interest rates going up are just, by a meaningful amount, have to be justified by structural forces behind the economy backing up these increasing yields. And I don't see them. So let's talk about what else could happen to yields. So what could happen now is that we enter a situation where either the Federal Reserve ignores the signals that different asset classes are already sending to them. If you look at the Russell, it is underperforming the Nasdaq by 17%. Probably you haven't noticed because it happens every day, slowly but surely. But since May, Russell has underperformed the Nasdaq by 17%. All right, and that's perfectly in line with what my global credit impulse would say. But it's happening. You see Chinese bond yields dropping below 3%. You see some industrial commodities repricing already. You see emerging markets underperforming developed markets. You see bond yields coming down, and you see the curve flattening on top. The market, I think, is starting to look pretty clearly towards the Fed by saying, okay, I think we've seen the peak. Please do not tighten right now. And I don't know what Powell is going to do tonight or going on. But, I feel that they always think they must use a window to get out of zero lower bound. I mean, if you're stuck at the zero lower bound and you're in charge of monetary policy, it's really complicated. It's because you don't have your distribution is truncated on the left side. If you want to try to do something on the left side of your distribution, you're almost truncated, and it's not a great position where to be. So I feel they want to try and engineer a way to reduce policy accommodation, but the market is screaming at them. Even without you start that, before you start that, I feel already uncomfortable. That's what the market is saying. So if they go ahead with that, what might happen is that the curve flattens even more. So the front end of the curve might start repricing a bit higher, tiny bit, to also accommodate a hiking cycle by the Fed or something that the Fed might signal they want to do. But if they go that camp, then inflation expectations are immediately going to reprice down, and the longer end of the curve is going to flatten even further to signal to the Federal Reserve that no, please guys, if you tighten now, we'll have to price even lower forward nominal growth, and therefore forward long end yields have to come down too. That's one option. The second one is that Powell actually is listening to the market and to different asset classes, and he comes in and says, actually, we were kidding with this tapering. So we're going to try to do something, but it's going to be that slow that it's going to be almost a farce. And, and then the market will say, well, but then this collateral imbalance is likely to continue. And, okay, you will still taper, so you do not accommodate further. Therefore, I cannot expect a steeper curve. I cannot expect higher yields because your push to accommodate further is over. You still want to tighten, but a bit less. So then we end up in a steady situation where Treasury 10-year yields maybe, navigate around 1%, and the long end of the curve stays between 1.5% and 1.75%, and nothing happens. That's the best case scenario. The worst case scenario is that the front end has to reprice because Powell decides he has to go forward. But then if that happens, I can tell you the long end of the curve is really not going to like it, and it's going to puke in front of the Federal Reserve, and it's going to flatten in till they realize this is basically a policy mistake.
Yeah, I think Powell doesn't want to taper. I think it's very clear he doesn't. I think he's under pressure to say that they're talking about it. So they're just trying to placate the markets a little bit by saying, yes, we're talking about it. But he knows these unemployment benefits are ending on September 6th. There's no way you could start tapering until you see what happens. So, but one thing I want to get into, because I know our time's a little bit limited, is Chinese stocks have been dropping last couple of days. I know last night they were up. There's the belief is this is due to regulatory changes. I kind of sense that maybe it's due to financial conditions tightening. Well, what's your take on what's going on over in China?
Yeah, always difficult to pinpoint exactly what's going on in China, but I can give it a try. So if we look at chart 4, which I produced for this conversation as well, it shows the Chinese credit impulse. So this one is not a proprietary metric. It's publicly available, the Chinese credit impulse. If you want to build a G5, you need to basically do some number crunching, which I do. But the Chinese credit impulse, publicly available, is the orange line on this chart. And it actually peaked as the earliest series in the G5 credit impulse. So China was the first country to actually stop producing an immense amount of credit and decelerating this credit. And you look at these changes in 10-year Chinese government bond yields even here, and they also tend to follow this very well with a lag of 12 months, right? So Chinese bond yields are dropping, and they were the first signal in this that China is tightened, there is less credit impulse, and therefore bond yields come down. It works the same also in China. There is no rocket science in this. It's how our monetary system is built. Chinese monetary system, same story. It's an elastic money supply. They can reduce it, they can increase it, and asset performance will depend on it, right? So it's the same story. Chinese tech stocks. Now, the overall accommodation in Chinese market is of course reducing. You see Chinese credit impulse dropping. That normally is not a great signal for stocks. But, if you're looking at different sectors in the stock market, and tech and growth stocks are the ones that are the least affected by this. because they're generally interpreted as a long duration proxy. They're a secular trend. They actually fit well into this back to secular trend story where the credit impulse fades and you slow down credit. So it's not the asset class that you suffer the most. So I tend to pinpoint the move we saw to regulation. Part of it, at least, is due to regulation. Now, do I think that the Alibaba, the Tencent, and all the tech stocks of this world are about to disappear? That's not in the interest of China, I would argue. So it's one thing to tighten regulation and to see a reaction overnight. It goes to show how much leverage is in the market out there. So a little, some news is able to actually rock the boat by a good 10 to 15% in a couple of days. So it's a pretty leveraged market and crowded market out there, and the credit impulse is fading in China. But you see already today that those Chinese stocks are repricing up. So I wouldn't be that worried about that either.
Do you see it as a leading indicator, what's going on in China and their stock market for what's going to happen in Europe and the US?
I would say Chinese credit impulse was the first one to fall. European and US credit impulse has fallen as well. And so it's peaked a few months later and has fallen naturally a little bit later. That's generally not a great environment for stocks, but especially for for cyclical, high beta stuff. So we're talking the industrial stuff, the cyclical stuff, the small cap stuff. Right, that's normally the one that is more dependent on earnings to actually deliver, right, their performance. Am I worried about growth stocks in the US? Not really, especially on a relative basis. So if I look at growth stocks relative to cyclical stocks, so the typical Nasdaq Russell comparison, then if I have to be involved in the stock market at this stage of the cycle, I would always prefer growth over value because the credit impulse has peaked. Therefore, value doesn't have a leg to stand on here.
Awesome. Well, I've got one last question for you. Personal question. Would you buy a 10-year Treasury bond with negative real yield? Would you do that?
Wow, that's a cool one. So I do own treasuries in my private account, but I'm based in Europe. So for me, it's very simple. I own them for two reasons. First is because they're denominated in dollar. And second is because I need an exposure to term premium when something goes wrong, right? So my portfolio is highly tilted to growth stocks for a large portion. So I need an offset for drawdowns. And so the TLT of this world, or long end treasuries or any other ETF or whatever, for my private account works well because it offers me dollar exposure and it offers me exposure to term premium. Would I own treasuries if I were a US-based investor that doesn't have the currency overlay into it, right? It's a good question, and I have to say that the answer at this point is still yes, especially long-end treasuries, because it's true that term premium is very low, but I can guarantee that when something goes wrong and we have to deleverage, the dollar will get bid and everybody will try to get their hands on collateral because this is a system where collateral is inherently scarce. Everybody will try to get their hands on it. Every euro dollar produced out there will at some point need to be backed by collateral. There are entities out there, Stephen, that actually are able to lend dollars away without having access to dollar liquidity. This is amazing, but that's how the euro-dollar system works. They can do that. Emerging markets can borrow in dollars without being able to get their hands quickly on dollar liquidity. That's basically true. So by definition, when something goes wrong, there will be a bid for the dollar and there will be a bid for collateral. And this collateral is treasuries. And as the short end of the curve in treasuries is relatively pinned to what I think to be a very geopolitical matter, which is 0% interest rates in America and not negative interest rates in America, as that is relatively pinned, all of the relief valve pressure has to come from the long end. So the term premium would collapse even further at that point.